This conference will now be recorded.
Okay, so good evening, everyone, and welcome back to a fresh new session on credit risk modeling. And we were talking about the regulatory framework. We were talking about BCBS, the regulatory framework. So while we were talking about the BCBS, so while we were talking about the regulatory frameworks, okay. So others, can you please be on mute? Otherwise, there would be background noises as the recording goes on. Okay. So thank you, guys. Okay. So as I was saying, right? So we started talking about, so we initiated our discussion, right, based on the so we initiated our discussion with some important characteristics. The first thing that we kind of spoke about over here is that we started talking about we started our discussion with the different kind of balance sheet and the financial statements that the bank would have, right, that a bank would have. And then from there what we did is we started moving into to understand the kind of regulations which would be there for assessing the capital adequacy, and for stress testing the capital requirements. And from there we gradually started identifying the key kind of capital ratios which would be there, and then the regulation in detail, right? So when we start talking about this regulations, about the so what we were trying to do was we were trying to understand the okay. Okay. So what we were trying to do talk about over here is that the different kind of exposures that the bank would have, right? So that a particular bank has, like the corporate exposures, the sovereign exposures, the banking exposures, the retail and the equity exposures. And while we talk about that, we talk about the corporate exposures and the retail exposures, right? Okay. So we started talking about the corporate exposures, right? So the first question that comes out over here is that what exactly is the corporate exposures? So over here, as we talk about it is, so as we talk about is the small and the, so we say that the corporate exposures are exposures for organizations which are, so by the carve, right, by the BCBS carve, anything more than 1 million euro will be treated as a corporate exposure or a commercial exposure. And within that, there are two parts to it. So one is an SME and the other is the corporates. So while I talk about an SME, any firm which has a revenue generation less than 50 million euro, that is called that is the proprietor. So that's an SME. Anything which has more than that is a corporate, right? So that is something that we would try to have. Okay. So over here, while we spoke about corporate exposures, while we spoke about so the corporate exposures, so over here we had so what we had over here is the so what we started talking about over here is the project finance. Now, while I speak about project finance, right? So this commercial exposure is something which is uh, there are different kinds of corporations we talking about. There is the finance, finance, estate, commodity finance, and high volatility commercial real estate. Right. So out of which we had started talking about the concept of project finance. Right. So when we spoke about project finance, so in a project finance comprises of that finance where you have a specific project, so which is financed end to end, uh, financed end to end by the loan, and the the basis of the funding revenue is generated from the project. So basically, the loan, so this revenue from the project acts both as a of collateral of repaying the loan, as well as what it forms a part of is that how the funding is, so how exactly is it that this revenue is generated from the project, and it is used both for repaying the loan, as well as it is from the generated from the project, right? So this is something that we would have with us. Now, the next question that we would talk about over here is the expected revenue. Now, while we talk about the expected revenue, so this is there is repayment of the loan, there is security against the exposures, and so on, right? Now, basically, what are the kind of projects which fall under this kind of financing portfolio? So, one of them is complex installation of heavy industry. So, mostly for heavy industry and for other finance, construction of new installations, or machinery plants, etc., mines, etc., for constructing new mines or new power plants, etc. So these loans are given. So these are heavily commercialized loans, right? And they are backed by appropriate revenue projects and revenue inflow estimation, and the the repayment of the loan. Okay. Okay. So this is what we had seen for project finance, right? So while we were kind of trying to move and while we were discussing project finance, we had talked about different kinds of so we were trying to think through like what would be the kind of loans, the nature of the loans, what would be the kind of the balance sheet items into which the bank would have looked at, and so on. So these are some of the things that we would have looked at, right? So we looked at EBITDA, we looked at free cash flows. So we talked about all those, right? So and we talked about how to define them and so on. Okay. So after project finance, so while we spoke about project finance, right? So a similar kind of finance, the second important exposure that we had or that we needed to talk about over here is the concept of object finance. So now this is something which is important, the concept of object finance. Now the question that comes out over here is that what exactly is the difference between object finance and a, a revenue finance? Have of now now over here this is used for, you know, yeah, so this is used for funding the buying of physical assets. So acquisition of physical assets. Or let me put it this way, that is there the acquisition of physical objects. Hold on. So acquisition of your physical objects. Of physical objects. Right now the question is that what are the kind of objects that I am talking about? So when I talk about objects, what are those objects? So those objects can be objects like ships, so ships, fleets, ships, you have fleet, you have aircrafts, you have satellites, and so on. So there can be multiple items like this which can be funded over here. You can have aircraft, you can have satellites, etc. Ships, fleets, aircrafts, satellite, etc. Right. So this is what we have. So over here, if you see this, so these are, you know, all kind of commercial or so these are heavy transportation. So different kind of heavy transportation. And so ship is a transportation mode, a fleet is a transportation mode, aircraft a transportation mode, and so on. So this is applicable for a heavy transports, right? So this is another kind of an exposure which a bank is expected to have. I mean, this is another line of lending. Right now, one thing you can identify over here is like, people buying aircraft would not be too many people, right? So buying aircrafts or ships or fleet would, so there would not be millions of people who are doing this, because these are very expensive stuff, right? So obviously these will be used for commercial purposes, not much for retail purposes. So therefore, ships, fleets, aircraft, etc., are all kind of heavy transportation, and hence obviously commercial the is actually very high, right? The volume is actually very high over here. Right. So these are some of the questions that we would get to see. So ships, fleet, aircraft, satellites, heavy transport, and so on. Okay. So over here, observe one thing. So now there are two things that you need to see over here. You know, over here, the products itself. So if I'm taking a ship, if I'm using a fleet, if I'm using an aircraft, right? Now, if I'm using them, I can use these products itself as a collateral against the against the default, right? So over here, some of these products will itself work as collaterals. Now, over so therefore, one of the things that depend over here is, number one is, so what will be the driving factors of the repayment? Again, over here we need to understand that how sound will be the repayment made by the people taking the loan, because if there is one borrower who defaults, right, I will be losing out a significant proportion of my exposure. So therefore, the first and the most important thing that comes out over here is, you know the the ability of the borrower to repay the loan. So that will drive this loan, because this loan is given at, so this is a kind of a loan which is given for an acquisition of a physical object. So what I need to ensure is that the person to whom I'm giving should be in a position to repay back my loan, and therefore the cash flows that will be generated by these uh, assets, right, by deploying these assets into business, will determine how much of a loan, or what should be the exposure of the loan that must go out to this, be it to object finance or to project finance, and so on. So over here there are two things. So over here I need to assess the repayment capability of the borrower, right? So how do I assess the repayment capability? Okay. So over here, number one, the repayment of this, the repayment capability over here is, right? So the repayment depends on the cash flow generated by the asset, the cash flow of the asset. So basically what you are doing is you are backing this asset that you are giving the loan by the cash flows, cash flow of the asset. Cash flow of the asset, right? And the debt serviceability. Okay. So over here, what we have is number one, cash flow of the asset, the debt service ability, right? Okay,
It's 9 o'clock.
fine. Now, while I talk about this repayment ability and the type of the assets, right? So from here, there are certain basic observations which I can see. You know, uh, okay. Now, given that you are actually taking a ship or a fleet or an aircraft, right? Now, the type of the contract that you can expect in here can be, you know, a typical kind of a loan or a lease contract. So this can typically be a loan contract, or it could typically be a lease contract. So what is a loan contract? In a loan contract, what happens is the loan is the money is directly credited to the, the money can be directly credited to the, so the money can be hit directly credited to the uh, account of the borrower, and then what you have is the lease contract. So in the lease contract, the bank would buy the ship or the fleet or the aircraft for the person, and what they would do, they would put it up on lease, right? Or basically, let's say for example, like like Jet Airways is flying, and they do not buy their assets, right? Buy their aircraft. What they do is they lease their aircraft from Boeing, right? And they use that to fly their airway services. So over there, what you have is a loan contract or a lease contract. So over here, what we have is the cash flow of the asset. We have the debt serviceability. In terms of the repayment, but yeah, so the way the contract is being done is a loan contract or a lease contract.
So, Tanmay, just a question. So,
Yeah,
the lease contract
tell
is
me.
between, say, s- say I want to lease a plane. For that, I need money. So, is that the lease
Correct,
contract is, right?
correct, correct.
Okay. Yeah. Okay.
And in a loan contract, it will be that I deposit the money into your bank and you just directly. buy the aircraft. In the other case, I am depositing the money into your bank, and what you are doing is you have a lessee and a leaser. So you are just reaching out to the leaser and you are taking that the aircrafts on lease, and I'm financing that. So that's as a bank, I'm financing that transaction. So both lease and loan contracts can be possible, are possible for an object finance.
And equipment finance will be part of the object finance, right?
Correct. Correct.
Hmm, understood.
So yeah, so if you have, instead of, let's say, a sheep or a fleet, you are buying certain equipment, certain, you want to install certain machinery into your plant, and you want to buy such equipment. So then that's a kind of object finance. Now it could also, be a part of project finance, because the reason I'm saying this is, let's say I have a heavy machinery plant and I want to buy a new processing plant or some steel processors, right? New equipments for my plant, and I want to upgrade my plant. So that contract can also happen as refinancing the existing installation, right? So as refinancing the existing installations. So in such case, it would also occur as a part of a project finance exercise. Does that make sense?
Yes.
Okay, fine. So this is kind of an object. So this is kind of what we call the object finance. Now, obviously, what are the sources, or what are the sources of risk that this can have? Now, the challenges that remain with this kind of object finance is, I mean, the risk that stays on with the object finance is the kind of the risk that you have when you are looking at an auto loans and lease portfolio, right? So if you are going to buy an auto loan or lease a auto loan, an automobile, what will happen as automobile? So what will happen is that uh, you may end up taking on an older car, right? So in older car, the depreciation costs are higher, and hence the net realizable value in case of a default will be something which doesn't add up too much due to very high values, right? So similarly, so there can be different kind of cases that can be considered while we talk about building the you know so while we kind of talk about building that framework or building these calculations of the type of projects and so on. So before I talk about building a model, so these are some of the important points that we need to take care of, right? Okay, fine. So while we talk about object finance, right? So while we spoke about object finance, the next kind of financing exercise that we talk about is the commodity finance. Now the question that comes out over here is that what kind of commodities am I talking about? What is it all about, right? So over here, what I have is about commodity finance. Now in object finance, we were trying to fund the, so what we were trying to do was we were trying to fund the objects. So we are trying to fund the purchase of these objects. So similarly, in commodity finance, there will be certain specific commodities, the purchase of which are financed. So for example, any crude commodities like crude oil, crops, metals, etc. So commodities which so the financing of purchasing the commodities is known as commodity finance, right? So over here with commodity finance, you will see that there is a major difference between object finance and project with project finance and object finance. There is a very important difference with this commodity finance. So let's try to understand what or how commodity finance would work. Okay. So before I go on to talk about of the commodity finance, let's very quickly look through project finance and object finance. I will just be back in a minute and we'll get started. Okay. Okay. So from object finance, now the next thing that we'll talk about over here is the concept of commodity finance. Now, what is the biggest difference between a project finance or object finance and a commodity finance? What is the biggest difference? Now, the biggest difference between an object finance and a object finance or a project finance and a commodity finance is that okay. So before I tell you the answer, right? What is the most important difference between a commodity finance and a jet finance? So while I say that, so this is done for financing, you know, for financing exchange traded commodities, inventories, like so exchange traded commodity like crude oil, crops, etc. Right. So, so, uh, so there is yeah. So these are the products for which commodity. So given that these are the things for which the commodity finance is done, the question that next comes out to us over here is that what exactly is it? So how exactly is it then different from object finance and project finance? So what would be the biggest difference with commodity finance and project finance and object finance? What do you think will be the most important difference?
Commodity is on a macro level, more on a macro level than a
Macro.
specific project and object finance.
No, not really.
I think there's a collateral involved in the other two, apart from project finance.
So collateral is there both in project finance, object finance, as well as you can have it in commodity finance as well. So that is fine. But what else?
Most of the commodities can be traded, as in traded in the exchange per se.
Correct.
Gold,
Correct.
gold, crude oil, blah blah. But you cannot see like projects or aeroplane being traded.
So what will be yeah, you are on the right track. What will be the implication on the lending patterns then?
So basically, in commodity finance, your size of the loan and uh, in object finance or the project finance, the size of the loans will be different. So, as in, say, a default occurring on a project finance or a object finance will cause you more loss than a commodity finance. Say you are providing like gold loans, so you can provide that gold loans to like common people like me, you retail customers. So how much of a loss will it make? It will be smaller scale. So the scale will be smaller here.
Scale will be smaller, so that's very close by. So you are more or less correct. But let's say that I have, so let's take a hypothetical situation, right? I have 1,000 rupees of project finance loan, 1,000 rupees of commodity finance loan, right? So let me just equalize this. Then what will be the key difference between these? The most observed key difference that you can think about. Think about the cash flow patterns. Okay,
The cash flow patterns would be linked on a macro level. Like there would be various factors impacting. Say for a foreign exchange, it would depend on like more
no,
factors than say a specific project or say a specific commodity like fleet or a
no,
airplane. If you're
I
financing.
don't need to make this more complicated. I just need to make it very simple. So think about it this way. So what are you funding? What are you funding in commodity finance? You are funding commodities like a exchange traded commodity, let's say like crude oil, or you are doing metals or crops. So the moment you are into financing these kind of products, right? So these financing is not a very long run product, long term loan. It is a very short term loan. So commodity finance is mostly a short term lending process, because you'll just take the oil, crude oil, you'll sell it in the market, you get the money, you repay the loan. So the window in which the repayment of the loan can be done as a part of commodity financing, as a part of commodity trading, and so on. So that is where this particular part comes into play. So we have commodity finance. Okay, so you are on a commodity finance, right? So basically, a commodity finance, right, is a short-term lending. Is a short-term lending. Is a short-term loan, right? So on one side, what I have is commodity finance. So over here, with commodity finance, I have what I have is a short-term loan. Whereas for a project finance or an object finance, the lending time period is larger. So the term is larger for a project finance or object finance, because the cash flows that we have, those cash flows will be kind of generated, or the cash flows will be very rapid for a commodity finance. So let's say I buy crude oil today on the exchange and I sell it off tomorrow, I make the profit. Now to buy that product, to buy that, I need the funds that is financed by the commodity, so that can be financed under commodity finance. So these are structured short-term loans. Right now, this short-term loan is given to which kind of product? So there are different kinds which are there. So one is obviously it's a to the this kind of loan is given to the finance reserves. Right. So on one hand, I have the finance reserves. The next that I have is inventories. Okay. So this is receivables of exchange traded commodities. Of exchange traded commodities. Okay. So over here I have commodity. So commodity finance is a short-term lending procedure, and over here the total exposure for the commodity finance is divided into financial receivables, and obviously the receivables from exchange traded commodities, because this is the reason why this domain is called the COVID. Okay. So now the question that comes out over here is that can the obligor independently pay the dues, right? The objective over here is no, they cannot independently pay the dues because they have to rely on the sale proceeds of the transactions. Okay. Okay, so these are the three things that we would have over here. So one of the most important characteristic of the commodity finance is that it is a so it is used to finance. So one of the key kind of commodities they used to finance it is the exchange traded commodities. Right now, these are the three important subclasses that we would have over here. So yeah, we looked into the project finance. We spoke about the object finance, and this is the commodity finance. Right. Okay. Now you have the income producing real estate, you have the highly volatile commercial real estate. We will talk about them sometimes later. But mostly the work that we will be doing, or mostly the products or the lending procedures that we will be studying as a part of this module, will be focused on each one of these resources for the commercial portfolios. So I will not be focusing on too much on highly volatile commercial or IPRE or HBCRE. So I am just keeping them out of the discussion as well, right? So if you want, so at a later time I can provide you written stuff on it so that you can go on and read through it. Right. So now with this, we keep the corporate exposures to this one, right? So these are the three broad subgroups for a commercial real estate. That is for a commercial portfolio, that is project finance, object finance, and commodity finance. Right. Okay. Okay. So the next set of exposure that we're going to talk about over here is the retail exposure. Okay. So after commercial exposure, the next set of exposure that we are going to talk about over here is the concept of the retail exposures. Now, retail is a very critical segment for any bank because most of the credit card acquisitions and behavior development and impairment calculation, anything. So or any of the so that is the reason why so whatever it may be, right, the retail portfolios are something which is very nice because you get to see a lot of variation in the overall behavior, right? So one very important characteristic of the retail exposures will be that they contain very huge number of accounts, and the exposures corresponding to each of the accounts are very small. So that is the reason why these loans are not treated individually, but rather they are treated as a pool of loan because the exposure corresponding to these two borrowers is less than that cut. Right. So this is so over here. The next thing that we'll do is we'll start off by discussing the concept of uh, retail exposure. Right. We'll define them and we'll identify its characteristics, each of the different characters, and we'll talk about the small, the different kind of exposures that we have. Right. So that's the next part of the discussion. Right. So just have a look into this, and I'll just be back in a minute, and we'll get started. Okay. So over here, the next thing that we'll talk about is the retail portfolio. Exposure. The why I talk about retail exposure, it says that a for a exposure to be classified as a retail exposure, we must have we must have the following different conditions. So there are three important characteristics that must be there for an exposure to be labeled as a retail exposure. Okay. So there are three important points. The first is there is low value of individual exposure. Low value of individual exposures. So over here, what we have is low value of the individual exposure. So there can be so the low value of individual exposures. The second thing that we have is there are a large number of borrowers. Okay, so over here, one thing that we see is that for retail exposures, there are low value of individuals, and the second thing that we get to see over here is the following: that hmm, so along with low value of individual exposure, so the next point that we have over here are the large number of exposures. Okay, so over here, what we have is we have large number of exposures. Achha. The large number. Okay, so over here we must have the large number of exposures. So these two are two important characteristics of any other agreements to the okay. Okay, so this is how the retail exposure will be defined. So whenever you are defining a retail exposure, define it in terms of the obligor size and the rating size, right? And if you see that none of them are giving a clear idea, what you can do is you can directly write a mail to Sachin and he would reply back. Okay, so so this is how we define the retail exposure. Now within the retail exposure, we will be talking about different kind of products. Like we'll be talking the credit card, we'll talk about the term loan, we'll talk about the mortgage loans, and so on. Right. So that's the next part. So over here, what we have is so we are classifying a retail exposure as a retail exposure when there is a low value of individual exposures and the large number of and there are large number of exposures. There is a volume of exposure. That is the number of accounts on the books of the bank is actually very large, right? And then what we are talking about is that these exposures must be managed as loans. So it should not be something like lease or anything. It will purely be a loan. Right. So over here we will be dividing in the next session. We'll be dividing this retail exposure into two parts. One is the qualifying revolving retail exposures, and the next part is the term loans, right? Or the other retail and the mortgage. So over here in the next part of the story, we will be looking into the how does the the retail the credit, the QRRE works, and how other retail and the mortgage works. So we will be dividing them into these three subparts, right? Okay. So let's take a pause here for the day. I wanted to introduce this retail exposure. So when we meet next Thursday, we will be continuing with or going deep into the retail exposure side, and from there we will move into to to estimate, to understand how these capital estimations are done. So we'll go into the calculation of the RWA and so on, right? Okay. So thank you guys. Thank you for your time. And let's regroup on Thursday, 8 p.m. 8 p.m. So I'll open the link by 8 p.m. Join the session. Thank you.
Yes.
Thank you.
Thank you.